This is the Nedgroup Investments podcast, where we explore a variety of views and insights that investors care about. Hello, I'm Demisha Greater from Nedgroup Investments Multi-Manager. This installment of your market and economic wrap is titled, "A Bumper Week for Central Banks Will Put Rate Cut Expectations to the Test." A flurry of major central banks are set to make their final rate decisions of the year in a week that will test market bets for rate cuts in early 2024. The US Federal Reserve will kick off what is poised to be a pivotal week on Wednesday. This will be followed by a Super Thursday, where the European Central Bank and Bank of England, along with others, will meet. Theories posed among some market participants about how quickly and deeply the US Fed will cut rates has been framed within two critical probable scenarios. In the first scenario, the US Fed would cut rates purely because the economy is slowing and unemployment is rising faster than expected. And if the unemployment rate starts to rise in a way that is consistent with past recessions, it is anticipated that investors will start running the historical Fed playbook and price in a rapid and more profound rate cut scenario. In the second scenario, the Fed would cut even though the economy is doing well. And this would be on the basis that monthly inflation figures have returned closer to the low levels seen before the COVID-19 pandemic. However, holding rates steady as inflation falls could lead to real rates rising, which the Fed doesn't want. Therefore, the conclusion drawn from the scenario is that Fed officials would cut nominal rates in an attempt to keep real rates steady. The big event on the international data calendar was the US employment data for November. This was released last week Friday. The data came in somewhat better than expected, while the household survey showed that unemployment rate edged down. Following the release, markets pushed back expectations for the timing of the first cut by the US Fed and essentially priced out the possibility of rate cuts as early as March. Reaction to the release of the job numbers saw the US dollar strengthen and US Treasury yields jump. Global equities were mixed. In the US, the S&P 500 and Dow Jones were marginally softer. However, the Nasdaq was up by a marginal 0.2%. In Europe, the UK's FTSE 100 lost, while the French CAC and the German DAX recorded substantial gains. The Japanese Nikkei recorded the most significant loss, falling by 3.4%. Domestically, real GDP was marginally weaker than expected in the third quarter, shrinking by 0.2% quarter-on-quarter from the downwardly revised growth of 0.5% in the second quarter. For the year to date, the economy has expanded by a mere 0.3%. The outlook for the rest of the year and into the new year remains bleak. The local policy front proved to be eventful as well, with the Cabinet approving the Draft Integrated Resources Plan, or IRP, for 2023 on Friday. This while a transmission investment plan was not yet approved. In other news, the Minister of Public Enterprises, Pravin Gordhan, announced that Daniel Morokane would step in as Eskom CEO in the next few months. And earlier in the week, the National Council of Provinces passed the National Health Insurance, or NHI, bill. President Cyril Ramaphosa has the option to send the bill back to Parliament, refer it to the Constitutional Court, or sign it into law as is. There is certainly said to be significant pushback from opposition parties, business organizations, and healthcare professionals. Against this backdrop, the rand was hurt by global risk aversion and the weak domestic economy. Local equities were also hurt by the dim growth outlook, with the JSE, or share index, down by 2.5% for the week. Basic materials were down the most, slumping by 8.9% as metal prices fell. In the commodities market, the Brent crude oil price dropped to below $80 per barrel, down by 6.1% for the week, as doubts about further OPEC output restrictions grew. Meanwhile, gold was buoyed by rising geopolitical tensions and dollar weakness, touching an all-time high of $2,152 per ounce on Monday. This before ending the week 3.3% lower. We have come to the end of our final note for 2023. We will resume on Tuesday, the 16th of January, 2024. On behalf of the multi-management team, I would like to wish you a lovely festive period. See you in the new year and take care.
Nedgroup Collective Investments is an authorized collective investments scheme manager in terms of the Collective Investments Schemes Control Act. Nedgroup Investments does not provide advice on financial products and will only give you factual information. For further details on our funds and to view our terms and conditions, please visit nedgroupinvestments.co.za. Nedgroup Investments, see money differently.